I'm Josh Jaskowski.
I'm Joe Simon.
This
What
is episode 5.
of the J&J Show. Welcome.
Pardon our dust as we were busy. Nevertheless, wanted to do a continuation of the questions that we were running through last time, largely because the questions come up all the time. Whether we did one podcast or 50 podcasts, people are always going to ask those questions. I think largely because they're conditioned to do so, whether you Google search or you go to Smart XYZ or you go to a wirehouse website, they're all going to include lists of questions they think you should ask. I would argue that we give very whole and transparent answers and also address some of the questions that I think advisors try to avoid answering.
Yeah, no, let's just knock them out and
Diving
answer
in,
here
diving
with
in.
our audience.
Yes.
Yes.
So one of the ones that comes up a lot, and it's one you'll see in most searches, is how do you get paid?
The old how you get paid question.
Yes.
I love it.
Shouldn't be, and you can tell me if you feel different. I don't think that's something that advisors should shy away from. I mean,
Yeah.
this is a job.
No,
You get paid to be a professional.
it's a business. We provide a service. And yeah, of course, we should get paid for what we do. Doctors get paid. Lawyers get paid.
Attorneys,
Attorneys,
CPAs.
CPAs, they all get paid, right? So we should definitely never shy away from that question. So, I guess I'll start by it depends, right? We always say that it depends.
And that's not a cheeky answer. That's
No.
a factual answer.
Absolutely. So we get paid in, variety of different ways. I think one of the main ways we get paid is through assets under management, right?
Yep.
So client comes in, they invest in a managed account with us. That's where we are primarily a fiduciary, right? And we
We're
charge
talking about advisory fees, discretion, things that we touched on previously about being a fiduciary being the bare minimum. Well, that's advisory to your point.
and we charge a fee because those accounts are actively managed. And ultimately every advisor that you talk to or work with, typically the fees up to their discretion.
Yep.
Some charge more than others. Some charge, a flat fee. Some charge a tiered schedule. It just depends on the advisor. It's up to their discretion.
Or the firm they work for.
Yes.
Because that's the other side. I know, for example, in my prior wirehouse experience, this was your fee schedule.
Yes.
That was it. There's no latitude. Doesn't matter if it's family, friends, more money, less money. That was their, might be somebody that has X amount of dollars that only wants to meet one time a year. Well, the fee's the same as somebody who wants to meet 6 times.
No, and I agree that the first firm that I worked with was the same way. The fees were the fees. The advisor had no discretion on what they were. But again, ultimately, I think it depends on where you're at. Us as independent financial advisors, we do have discretion.
Yep.
And I think, for us, we try to be fair. I mean, we try to provide great service, get our clients, good returns at a reasonable cost.
No, certainly agreed. And that's just one leg of the stool of however many legs you may have. And that's the predominant discussion right now is fee-based, advisory, and it makes sense.
Yeah.
It allows us to be both tactical and strategic, which I certainly like. It also is mutually aligned interests.
Yep.
You're being a fiduciary, the mutually aligned aspect being, and some people, again, shy away from this, but it shouldn't be something people don't want to hear. I get paid more if you make money.
Absolutely.
Our interests are mutually aligned.
Yep.
Last time I'll say it. If you lose money, then I get paid less.
Yeah.
So, but that's only because we're doing an active service to
Yeah.
your point. That's in contradistinction to something like, and the word brokerage is thrown around a lot. Some people say brokerage account as in non-retirement,
Yes.
non-IRA accounts. But in our world and most of the places I've been, there's advisory accounts and there are brokerage accounts of any tax treatment. That doesn't so much matter. But the reason I go into brokerage is that's where you're looking far more passive.
Yeah.
Of something that you might have a strategy or structure that you buy and hold to maturity.
Yep.
And the statement is, well, I'm not going to charge you on something we're not managing. But that's kind of changed a little bit over time too.
It has. I mean, and there are certain vehicles that can be, purchased or in either type of account, whether it's a brokerage or an advisory. And it's one of those things I think as a prudent advisor, we try to balance out, right? If it's the same exact investment that's available in a brokerage platform versus an advisory platform where you charge a fee, well, the returns have to be enough to overcome the fee if we're going to put it into advisory. And sometimes we do find that within, some of, for example, the structured products we use, it may in brokerage pay, 10% a year, but advisory, it might pay 12. Well, in that case, yeah, it makes more sense to do it in an advisory platform because the additional return overcomes the annual fee.
Certainly. And that someone comes down to your point, what is somebody charging you?
Yeah.
If they're charging you 2%, which some people do, I'd argue that's a high fee, but some people do. Maybe they're running option strategies for you.
That's their right, right?
Okay. That's going to make it more expensive, but all else equal. And it's also, I think, a little bit the culture or the nature of the business now is with a larger push toward advisory. The advisory strategies and products are becoming more attractive to people to go that direction. It is a case of, and perhaps it's fickle because we're in the business, but it is a business where you get what you pay for.
Yes.
If you're going to or are going to be willing to pay, let's just say 1.2% fee to have a cumulative return that's 15% higher, I'm going to take that every time versus something I didn't pay a fee on is going to be the same as the market, for example. And it's not, I mean, we talk about it with our clients, it's the transparency, where a few years ago, it might have been a little bit different, particularly when it comes to brokerage versus advisory. It also very much, to your point, has to do with the structures. If you're buying a bunch of stocks in a brokerage account, somebody's probably charging you a commission for that. And I've had people talk to me in the past that don't formally work with advisor and view that as a benefit of, well, my person doesn't make any money off my accounts. Well, they charge you every time they make a trade, correct? They just have no vested interest in how it does.
No.
So the idea of keeping fees to a minimum is valid. And that typically has to do, in my opinion, a lot with investment expenses. That's really where you get the heavy fee load. But advisory versus brokerage, I mean, there's a reason the industry has moved toward advisory. And some of the products and strategies have followed suit.
Well, and I think a lot of it, and again, most of it comes down to what you'd mentioned earlier, is that mutually aligned interest, right? Because we know the reason for that push was, 30, 40 years ago, right? Before we had these managed accounts, well, the only way for an advisor to increase their revenues or create revenue was to buy and sell something, right?
Commissions.
So, and again, I like to think that most advisors do the right thing, but you've had those advisors that, hey, you know what? I need to, I'm going on this vacation next month and I want to create some revenue to pay for it. Yeah, it's been a slow year. Well, let me pick a couple of stocks in our portfolio. We'll liquidate those and create a commission on the sell, and we'll buy something else and create a commission on the buy, and I'll generate some revenue, even if it wasn't probably the best thing for the clients. I'd like to think that doesn't happen, but we know that does, and it has happened. And that's a large part of the push towards advisory in actively managed accounts and in fee-based services, so that, again, we're all aligned, right? So the client knows that, hey, you know what? If Josh and Joe are recommending a transaction or a trade, it's because it's what's best for the portfolio and the growth of the portfolio. Because if we make the wrong decision, well, we're going to make less money.
We're married to it.
Yeah, we are. Yeah. Our revenues will go down.
And it's going to be a case of, hey, we gave this its due time. Didn't work out. We need to make a change. It's and commissions still come up in the world, even in some of the, if you're doing the best quality of planning and recommending the best tool, that doesn't mean, because commissions is a funny word depending on who you talk to. I always like to use the example of, say you have a real need for life insurance. And some people do. There's no fee-based life insurance to my knowledge. It's going to be that if you went to one of the big names directly, they would get paid the, let's call it 1 through 5%, whatever the schedule, whatever it happens to be structured as, or some percentage of target premium. You can go to a major firm and use the 1-800 number and they get paid that. Or you go with us, we implement it into your financial plan, we do the ongoing advice and get paid the same thing. But there's no ifs, ands, or buts about that. That's how that strategy is paid.
And we actually price it out for you. And, we'll go to 50, 60 different vendors through our system and get you the best pricing as well. And we're quite frankly agnostic to that. Where our goal is just to get you the best pricing. It doesn't matter, who it's with, as long as they've got the proper ratings, right? We know they're a good, solid insurance company, and the policy meets your needs.
Within your budget.
It's within your budget. Yeah.
It satisfies the goal you're trying to get to, has the number. Because it's a case of, we also know life insurance companies, for use them as an example, are businesses. They make business decisions. It may be the end of their fiscal year,
Yeah.
and they're more willing to undertake your risk because they're more unwilling to take in that
Yep.
revenue.
Yep.
It may also be a case, and we know this to be true, some carriers are okay with conditions that others are not.
Absolutely. Yeah.
In some cases, if you have a physical ailment, some life insurance carriers are perfectly fine with that.
Yep.
But if you have, if you're diabetic or overweight, or while BMI, I would argue, is not as relevant as it once was considered, they go by that.
Yep.
So it's a dynamic landscape out there. You get what you pay
Yeah.
for.
And that's something we probably, on a side note, right, should talk about at some point is, life insurance, going through the application process for a client. And the fact that, a lot of times clients don't give us all the information, right?
Yeah.
And we find that out after a medical exam. And honestly, had they given us that information earlier about a certain condition here or there, well, then we could have went out and shopped the best vendor
Yeah.
for that specific condition to get you the best pricing.
Well, and since we're on it, that's probably worth the snippet
Yeah.
because it's the big thing we see. And I think what's underappreciated, taking a quick segue into the world of life insurance, which could be 18 episodes, if not more by
Yes.
themselves. But the big thing we see that I think, as you're alluding to, we would ask people not to do is, if you have those conditions, please tell us.
Yep.
Because it probably would be better to do something called like a trial application to multiple carriers based on your health condition. Because if we go down that road and you get rejected, that now has to be answered honestly moving forward, that you have been rejected for the life insurance policy.
And honestly, in a lot of
Fine.
cases, we can call, one of our insurance specialists internally, and they're going to have an idea of which carriers to go to for certain conditions too, because every carrier is different
It is.
and they all view risk differently.
And I would say this also is, just because you were declined for a policy doesn't mean that your world is drastically changing beneath your feet.
No.
Because again, a lot of these are business decisions. A lot of these are, hey, we'll gladly insure this specific issue you have, but not the more mainstream issue because we specialize in that. Don't take a declination as something is changing in your world. Maybe there's some info in there that you should have about your health. Maybe your health isn't what you thought it was. It's an opportunity to make a change. But don't view, a declination as the end of the world, particularly if it's only because, you didn't disclose something out front.
So that was a little off the main topic, but I felt it was important we discussed it when it came up. Yeah, absolutely. Otherwise, we may not get back to it for 10 or 12 episodes. So, but back to how do we get paid? So we talked about advisory. Do you want to talk about brokerage a little bit?
Yeah. So talking about brokerage, as we touched on, that's the commissionable side of things, depending on what you're using. It might be fixed commission. It might be an upfront sales charge like a mutual fund. It might be a fixed amount depending on the firm, like an ETF. If it's a stock, it's definitely going to have commission. Inside the brokerage channel, which in contradistinction to advisory, because we're covering all those fees because you're paying us a fee, there are no trading fees inside of the advisory models or design or accounts, depending on that's the way the advisor
sets it up. We personally do it that way. So our thought process, you're paying us a management fee. We're going to cover all the internal costs. Not all advisors that way. I've seen advisors that will charge you 1.25%, 1.5%, and all the transaction costs on top of it. It's just not, I think that's probably, for me, not the right way to do it. But, again,
it's a little bit double dipping, in my opinion, particularly, and I would feel less adamant about it if I, the individual advisor, was not choosing to make those trades, and therefore imposing them upon you.
No, I agree. I think
so. If I'm the one making it, I think it's only fair that I'm the one covering it, because I think it makes sense. And if my conviction's that high that this is going to make sense, then I should want to get paid on the fee-based part.
Absolutely, I agree.
Not some sort of transactional fees. But in the brokerage world, broad world, again, we use structured products that don't have a fee for the client. That naturally segues into, yes, it's a brokerage world, but you get paid on commissions.
I would say very rarely would we use a brokerage product where the client is charged.
Agreed. To your point, the only place that I see it in our practice that it comes up, and this is a little bit niche because it's based on firm. Unfortunately, a lot of them aren't the most lucrative. It's CDs. CDs are commissionable, and that's kind of how it is.
It's that, and then when a client of ours, again, it's not typically our business to hold individual stocks or trade individual stocks for our clients, but we do have some clients that we hold them for, and it will come up if the client wants us to do a trade, but that's, again, not us with discretion. That's them making the request.
And it is also then up to us as to, do we want to charge that commission?
Yeah.
Do we want to walk it down to where, and we have this a lot of, hey, we'll do this trade for
Yeah.
you, but I, as the advisor, I'm not going to pay for it.
Yeah.
I don't want it to be on my ledger that it's going to cost me $50 to do the trade you want to do. We'll get it down to as low as we can to just where it doesn't cost us.
Yeah, I mean, honestly, I think pretty much in any of those cases, if the client has an advisory account or a managed account where they're paying us a fee, we typically will discount the trade again to a break even for us. So we're not actually making any money, but we're not losing any money on it.
Yep, correct. And I think that's reasonable.
Yeah, no, it's
And of course, based on your relationship, you may decide you're just going to eat the fees based on something else, or maybe going into something that has a commission that's a wash. And I mean, that, to your point, brokerage dovetails directly into the world of commissions. We talked about life insurance briefly. Annuities can go either way.
Yeah.
There are fee-based annuities. There are annuities where, and this is something the advisor gets to elect. It shouldn't ultimately change the relationship, frankly, but some advisors are going to take reoccurring revenue off of an annuity. Some are going to take an upfront amount. You, as the client, will most likely never know.
It doesn't affect the product or the features or benefits for the client.
It's a business decision on the side of the advisor. But those are, again, that's just how they work. Much like life insurance, those are commissionable products. Whether it goes straight to the firm providing the annuity or the individual you're working with, again, I would always say, rather than having the 1-800 number, I would hope that if people know all else equal, if they're going to be paying XYZ, that they'd rather work with somebody.
But to wrap it all up and tie it all together, the one thing that we can tell you in working with YTS is, if we're going to implement a strategy or product for you, we're going to be transparent about what the costs are.
Yeah, we'll give you the full weighted fee. That fee is going to include any investment expense, which we keep pretty low. But it's going to be a full weighted fee of everything we're using. Even on a brokerage account, if it costs you $40 a year, we're not putting that in as a weighted average. It's going to be a lot of zeros in that decimal, but nevertheless, I'm putting it in there.
But again, I think we think it's extremely important to be transparent about fees. We don't want our clients to think that, we're not, we're hiding anything. And again, I always say it doesn't do us any good or the client any good if they're, looking in a statement 6 months after, investing with us and wondering what they're paying and why they're paying it. So we want to be, again, always upfront about that. And that's something we go through line by line in our investment planning or action plan meetings.
And everyone should.
Yeah.
I mean, that should be the standard that you expect from your advisor. Again, it shouldn't be if they, shriek or irk away or hide from the fees.
I'd be concerned at that point. Yeah.
It should be something they should be more than happy to tell you, because, and I normally steal your phrases, but I'm not going to steal this one. You have a very specific phrase you use around fees and when people care about them. And it's when there's an absence of something.
In the absence of value, that's when fees are an issue or cost is an issue. 100%.
If they're not providing you the value, then you do probably care about fees. Not to say you shouldn't always care about fees. But again, if you're paying 1% to make 100 or paying 0 to make 50, I would hope that the numbers would tell the story.
And again, that gets to your point where you said, just because an advisor charges a high fee, there may be a reason. So I don't want to discount that or poo-poo advisors that have high fees. They may have, again, extremely sophisticated option strategies or, going on.
If the proof is in the pudding, and again, the hill I will die on is the numbers of, if someone's showing you that they in every market environment are beating the market, that's worth something. I'd probably pay 2, 3, 4%. If you're telling me I'm going to beat the market by that every time, no problem.
No, so absolutely. I don't want to poo-poo an advisor that has high fees. You just got to ask the questions as to why and what you're getting for it, right? And if they're providing value for that, then hey, that's great.
Well, and one of the outliers is also, are they also doing planning? Are they doing planning as part of that fee, or is it a separate fee? Because I've seen both. Is it an hourly fee if you want to plan? Is it a flat rate? Is it built into your advisory relationship? That's also a big case of it depends.
And again, with us, it's all built in. So, when you come in, you're an advisory client with us, the planning's all included.
Things you can include are, if you're running a multifamily office style or a family office style, tax fees may not be a part of that. Legal fees may not be a part of that. They may have a friendly relationship like we do, that it's not going to be an off the street rate, but there are just some things that can't be blended in, depending on the sophistication, and if it's something that it's associated with a bank, there may also be other things going on there. hey, your fees are going to be your fees, but inside your high yield savings, we're going to give you another 0.1% or whatever it happens to be. So fees is a broad thing, but the honest answer and the answer that I think any advisor should be giving is it depends.
Depends. Yeah.
And if you're saying I don't care if I'm giving up returns, I don't care about any of that. I just want to have the absolute lowest fee possible. I'm going to tell you, I don't think that makes the most sense, but there are solutions for that.
Yep. Well, on that too, when I think about that and what you just said, brought up the fact that, when you're talking to your friends about what they're getting, working with their advisors and their fees are different, they may be lower, but you got
Yeah.
to think about what they're getting for that fee versus what you are.
Or to your earlier point, they may be higher,
Yep.
but maybe their average annualized is 17%.
Exactly.
That's a big number, and they might know something.
Yeah.
And you should probably want to work with them. You should probably want to
Yeah.
pay that fee.
So ultimately, it's not a one size fits all,
No.
right? So you got to delve a little deeper. You got to lift the hood and look,
Yep.
and see what you're getting for your money.
Yeah. And then you're, situational.
Yep.
If you only have one account or you only have a few $100, yeah, you probably want to be super streamlined on fees. You're not going to be able to get the value out of that. But, you got a couple $1 million in plannings in play. This is a business where you get what you pay for. I would like to think that I think most attorneys are that way.
Yeah.
Most CPAs are that way. While sometimes we may not be viewed in the same light, this is the same circumstance that you get what you pay for. So to your point, how do we get paid? There's really two ways. It's either going to be some sort of commission or some sort of fee based with any number of ancillary things that could come up. But it should not be a big lift. And at least I know in our case, we put it up front that in the implementation meeting, we're telling you what those are.
Yeah. So
you got to come back later. Well, it's not as good of a look.
And ultimately, that's the key is just, as a client or potential client, just to wrap it all together, just when discussing fees, just, keep in perspective, what are you getting for the fees, right?
Value.
Yep. And transparency is what you want. If advisor's not being transparent, then you probably should rethink what you're doing or rethink that relationship.
Absolutely. And don't let them hide the investment expenses.
No.
That's one that never shows up on a list, but it's always there. So it's always fair to ask.
Absolutely. Excellent. Well, I just want to wrap this one up and we'll just hit another question on the next episode.
Doesn't matter unless we just want to try to zing out a short one. Like, do you have a specific minimum investment?
That's a short one.
Yeah.
No.
Yes.
So, obviously, every advisor wants the $1 million client or $2 million or $3 million client. Great. We love that too, right? But again, as a business thinking long term, we have to have younger clients to eventually replace those older clients that have $1 or $2 or $3 million as they, pass on down the road, right? So thinking, as a business thinking long term, yeah, we need clients that are in their 20s, 30s, 40s, 50s, 60s. And guess what? A 20-year-old client's not going to have $1 million, right? A 20-year-old client may only have
Not most of the time.
No, that's true. Unless, they got that.
There could be inherited, it could be crypto, it could be, that does happen.
Yeah.
But that touches on, I guess, what's easier for me to talk about being on the younger end of the spectrum.
Are you calling me the old guy again?
Just older than me.
All right.
Whatever that happens to mean.
Perfect.
But it is a case of if you have somebody in their 20s and 30s and you can give them something just better than the main.
Yeah.
If you could get them a leverage strategy, if you could just get them on the right path early, is it ever too late to start? No. But is there ever a substitute for time? Also no.
Yep.
So if you can get someone aligned to they should be aggressive, they want to be aggressive, you can get them leverage, you can get them some strategy that has them ahead of the game. The compounding nature of that is enormous.
Yep.
I think for us, because we have a firm that includes a lot of both younger advisors, younger clients, et cetera, I think we take a more active approach to that. We take on clients that they may have, because in some worlds, wealth is absolute, in others it's subjective. All comes down, as you like to say, living expense. What is the lifestyle you're trying to maintain? But it might be somebody who has a couple $100,000 and their kid has maybe a few $1,000s.
Yep.
But getting them set up early and okay, for the next 40 years, you're going to be getting better than market level returns. You're maybe going to be, depending on the strategy, getting 2x market level returns. Well, you could potentially have more than double the wealth that you would have on your own.
Yeah. And I think, tell me if you think differently about it. The only requirements that I think we really have, or even, just I have when working with someone, is no matter what age they are, no matter how much they have with us, they're engaged in the planning process with us, right? And they're open to taking the advice and guidance we give them. That's what, at least in my mind, are, the must-haves.
Yeah, I agree. I mean, if you have a specialty thing you're interested, to your point, because you mentioned crypto, that's not a world we play in.
Yeah.
And if that's what you want to do, that is certainly your right. I'm not going to argue with some of the numbers. That's not an area I can assist you in.
Yeah.
And that's fine. If you say, okay, however, and I do abide by, the don't gamble money you're not willing to lose
Yep.
type thing. Typically, retirement accounts are not accounts you do gambling in because that's not what they're for.
I'll tell clients that, listen, if you want to do that, great. Create an account, handle that on your own.
play it,
That's play with it. I always tell them though, understand that you may lose. It's kind of like that money doesn't exist anymore, right? Because it is in some sense kind of gambling, right?
Oh, it certainly is.
And then just leave us to manage your long-term money, your retirement money, the money that you're going to need to be there for you, 10, 15, 20, 30 years down the road.
And if it's something you do really well with, well, then you might need some planning.
Yep.
And if it's something you do really poorly with, well, you may also need some planning of a different type. But if it is a case that you do something out there and you do really well, there could be a lot of ramifications to that. And that's a lot of what we used to hear in the headlines. I think it's a little more muted now. But, crypto millionaires that harvested all their gains, never paid a tax, and then the IRS came around and now they're on a payment plan or they're in jail.
Yep.
So again, it's all the things, and that's also what goes back to, do we have a minimum client size, age, any of that? No, because that may be the one person we talked to that one time about planning that saves them from that. Okay, by the way, you might want to keep 30% of your wins for your taxes. Something so simple, but financial literacy, well, you can talk how you want about financial literacy. A lot of people don't get the financial education they should. And just being able philosophically to make one comment and they make the difference between you going to jail for not paying your taxes versus you set a little bit of money aside, that's worthwhile. Yeah. How much time does that take? Well, 10 minutes.
So ultimately, we don't have a minimum. We just ask that you're engaged in the planning process and you're open to advice and guidance.
Yep.
So with that, I think that wraps up our first episode, right? So before we wrap it all up, this is the J&J Show. Like,
comment,
subscribe. See you next time.